Hello. In this video, we'll talk about corporate formation, the tax consequences of corporate formation, and we'll look at this through problem. This is problem number 1. So avocado and banana form Coconut Corporation to engage in the fruit growing business. Avocado and banana, which avocado and banana are both individuals, they each receive 50 shares of Coconut Corporation common stock in exchange for contribution to Coconut Corporation the following. So they're going to contribute the following assets. Now note that all amounts that are given are at the date of contribution, and all exchanges, the assets for the stock, occur all on the same day. So avocado is going to, in exchange for getting 50 shares, avocado is going to give Coconut Corporation a truck which is held for business purposes. So it was used by avocado in business for 3 years. It has an adjusted basis on the date of contribution to avocado of $50,000 and a fair market value of $150,000. A power shovel, which is also held for business use, and avocado has used it in business for 13 months. It has an adjusted basis of $125,000 and a fair market value of $100,000. So avocado gives those two items in exchange for, and avocado gives those to Coconut Corporation in exchange for 50 shares of Coconut Corporation common stock. Banana gives cash, which the amount of cash is $100,000, hence why the amounts are equal, and land, which banana held for investment purposes for the last 10 years, adjusted basis $20,000, fair market value $150,000. Note that if you add the fair market values together, 150 plus 100 and 100 plus 150, each taxpayer, avocado and banana, they're each giving $250,000 worth of items in exchange for 50 shares of Coconut Corporation common stock. So this is an arm's length transaction, and that means that avocado is going to own 50% of the corporation after the transfer. Banana is going to own 50% of the corporation after. There's only going to be 100 shares, and each one they're giving $250,000. So the corporation is going to be worth $500,000 on once all the assets are transferred to the corporation. That's really important to understand because that's going to be important when we're looking at the tax consequences. So with respect to the tax consequences, when a corporation is formed, which here Coconut Corporation was formed by avocado and banana. So this is formation. Coconut Corporation was formed. Whenever there is a formation and or a party contributes. So not only on formation, but what if a party just contributes? Well, we have to look at some special tax rules, okay? And it has to be property in exchange for stock. Then we have to look at the Section 351 non-recognition rule on corporate formation or contribution, the rules. And I have some checklists that are going to help us. And there's really 6 different steps that we need to look at and we need to go through in order to determine the tax consequences. And it's important to go in order because if you're doing the CPA exam or some type of law school exam or accounting exam, then it will help you be quick in terms of getting answers. And if you go in the order, it will make sure that you cover all of your steps. Okay. So the first thing that we worry about is the gain or loss recognized by the transferor shareholder. So the transferor is the party that's transferring the property in exchange for stock. Now, you have to do this for each shareholder, each transferor shareholder. Here, avocado and banana are each transferor shareholders. So we have to look at both of them independently with respect to any gain or loss that they recognize. The next step, after you calculate the gain or loss recognized, if any, is then to determine the adjusted basis of the stock received. And if applicable, other property that is received. So here, avocado and banana are receiving stock in the corporation, so they're getting stock in the corporation, which is what we mean by the basis of stock received. But if they were also receiving stock and let's say some cash from the corporation or some other property, I don't know, maybe some inventory or a piece of equipment, you would have to calculate the adjusted basis of the stock received and other property received. You got to do that for both. Not just the stock received, but also other property received. That's going to be important. The third step is determine the holding period of the stock received. So here, the 50 shares that Avocado and Banana received, we have to determine the holding period with respect to each shareholder. And remember that the holding period is important. If you remember back to your basic tax concepts, holding period, when you look at long-term capital gain versus short-term capital gain, you got to look at holding period. And remember that almost all taxpayers' stock in a corporation is a capital asset. So that if you hold it for a long-term period of time, you can get long-term capital gain, which makes a difference. It has preferential rates over short-term capital gain. Okay? So that's important to understand. Also, when you're dealing with losses. So depending on how long the stock is held, and let's say it's sold a few days after this transfer, it affects the tax consequences. So we have to determine the holding period as of the date of transfer, because that will obviously continue on from that date. We get to add on those days. But what about on the day of transfer? So you're going to learn about that. So the first three steps, they deal with, again, the transferor shareholder. And you have to do that for each respective transferor shareholder. So here we have to go through and do steps 1, 2, and 3 for Avocado. And then we have to do the steps 1, 2, and 3 for Banana. So step 4 is to determine the gain or loss recognized by the transferee corporation, which here the transferee corporation is Coconut Corporation. It's the party that's receiving the property in exchange for the stock. Once you do that, step 5 is to determine the adjusted basis of all property received by the transferee corporation. So here, Coconut Corporation is the transferee, and Coconut Corporation receives 4 assets: a truck, power shovel, cash, and land. So you have to determine the adjusted basis of all property received by the transferee corporation. Because if those pieces of property are sold later on, you need to know what the adjusted basis is for determining tax consequences when the corporation sells or if it distributes out. Finally, step 6 is to determine the holding period on all property received by the transferee corporation. And this is important again because if the transferee corporation sells off any property that it receives as a result of this contribution, then you have to determine the tax consequences. So steps 4, 5, and 6 all deal with the corporation. They all deal with the corporation and tax consequences. So again, step 1, 2, and 3 here, we're going to have to go through with respect to Avocado and Banana. So we're going to have to do step 1, 2, and 3 for Avocado, step 1, 2, and 3 for Banana, and then we would do step 4, 5, and 6 overall for the corporation. That's the way that the order goes. And order is extremely important. It's very important to go in this order because if you do go in a different order, you can potentially it becomes inefficient in a sense because when you start getting to certain steps, like step 5, for example, you need to know what the amount of gain recognized is in step 1 to determine step 5. So you don't want to do step 5 first and then have to do step 1 and then go back to step 5. You want to do it in this order because it will help you make sure. Now, if you do have a question that asks for a specific item, you can skip to that step and do that item. But if you're solving for the entire problem, like we're going to do in this problem number 1, you want to go through these 6 steps. All right, so now let's go through these 6 steps and we'll go through an order and we'll talk about these things and how exactly they're applied with respect to the tax law. Okay. So let's go ahead and start with step 1 for Avocado. So we're looking at the tax consequences with respect to Avocado, and we're looking at this corporate formation issue. Now remember that step 1 is to determine the gain or loss recognized as a result of the transfer of property by Avocado, which here, the truck and the power shovel, in exchange for the 50 shares of Coconut Corporation common stock. So whenever you have any type of property transaction, whenever you have any type of property transaction, it's always important to apply the general rule under Code Section 1001. Section 1001, this is our gateway provision. This is where amount realized minus adjusted basis gives us our realized gain or loss. Amount realized minus adjusted basis. This gives us our realized gain or loss. Our realized gain or loss. And remember that if we're determining what amount of gain or loss is recognized, we always start by calculating the realized gain, because if there's no realized gain, then there can't be any recognized gain. That's the idea. And then if you have a realized gain or loss, remember recognized gain or loss is actually what goes in the tax return, so that's what's important. So to calculate our realized gain or loss here, it's the amount realized, which if you can look through the tax law in Code Section 1001 or in the regulations in 1001, and you can go through the technical definition, but it's really, what is Avocado getting? Well, Avocado is getting 50 shares of Coconut Corporation common stock. And as we talked about, this is all arm's length. So remember, what is the value of Coconut Corporation? $500,000 after this transfer. It's the value of all the property. And Avocado is getting 50% of that. So you take $500,000, the value of the corporation, and Avocado is getting 50 shares, which equal 50% because there's only 100 shares total. So that equals $250,000. So Avocado is getting stock worth $250,000. And this is all at the date of the transfer. This is all at the date of the transfer. Now, we subtract from that $250,000 the adjusted basis. Now, adjusted basis is a term in the tax law that has its own definition of those items. With respect to the adjusted basis, it's the adjusted basis of the property given up. So Avocado here is giving up two pieces of property. Avocado is giving up a truck, which has an adjusted basis of $50,000. And Avocado is giving up a power shovel, which has an adjusted basis of $125,000. So we add both of those together. And we subtract away the adjusted basis from the amount realized. So that equals $175,000. So that means our realized gain here for Avocado is $75,000. That's the realized gain. That's not the recognized gain, that's the realized gain. That's important to understand first, because if the realized gain or loss is zero, again, you don't have to worry about calculating recognized gain or loss because it's going to be zero as well. Now, one thing I want to note is that for the amount realized, that's going to be the amount of cash received, which Avocado receives none, plus the fair market value of property received, which Avocado receives 50 shares of Coconut Corporation common stock, plus any constructive cash, which is liability relief. So if Avocado was transferring one of these pieces of property, like the truck, and there's a mortgage on that, which Coconut Corporation assumes or takes subject to the mortgage, takes it over, that's considered liability relief. And finally, the fourth thing is that we subtract away any selling expenses, which there's none here. Example of a selling expenses: if you're selling your home and you have to incur some closing costs, pay a realtor or whatnot, then that's considered a selling expense. So again, amount realized is cash plus non-cash property, which is what we have here, right? That's the $250,000 plus a liability relief minus selling expenses. So that's what we do. We calculate the realized gain, which here for Avocado is $75,000. So now we're going to talk about the recognized gain or loss. Okay, so now that we've determined that Avocado's realized gain is $75,000, we have to determine if that $75,000 realized gain is also recognized. Now, since we're dealing with corporate formation and we have the special rules and we're dealing with the gain or loss recognized, we have to talk about Code Section 351A. So Code Section 351A, the tax treatment rule says no gain or loss shall be recognized, which means it's mandatory. Shall be recognized. Mandatory provision. And this applies to the transferor shareholder. which here is avocado or banana. And we'll talk about banana later on. The transferor shareholder does not apply to the corporation transferee. Okay? And there's 3 requirements that have to be met. There's 3 requirements. We're going to go through all 3 of these, and we're going to see if avocado does meet these. And avocado does not want to have to recognize $75,000 of gain. Okay? Yes, there's realized gain because the realization event has occurred under our Glenshaw Glass, the realization event, right? That's been triggered. But what about recognition? Which, if you remember from our previous discussion or videos, recognition, there's certain tax policy that maybe we don't want to have to encourage, maybe there's no liquidity, or maybe economically it makes no sense, that's what's going on here. So the first requirement is there has to be a transfer of property to the corporation, to a corporation by one or more persons. Okay? Property to a corporation. So property has to be transferred to a corporation. Do we have that here? Well, we have to define what exactly does property mean. So property is not actually defined in Code Section 351, but it is very broad. It's very broad. It even can be something as broad as intellectual property, a thought or whatnot, intellectual property. Well, here avocado is transferring truck and a power shovel. So that meets property. So avocado is transferring along with banana property to a corporation. So requirement number 1 is met. Sorry, I'm getting ahead of myself, right? Requirement number 1 is met. And we have to meet all 3 of these criteria for 351A, no gain or loss shall be recognized to apply, okay? So the second requirement is that it must be solely in exchange for stock of the corporation. For stock of the corporation that is involved in the transfer. Okay? So the property is being exchanged solely for stock. That's key, is solely for stock. So what is avocado, because that's who we're looking at here, what is avocado receiving? Avocado is receiving 50 shares of Coconut Corporation common stock. Now, common stock is plain vanilla as it comes, is stock. Okay. Now, the tax law does deal with certain preferred stock. Certain preferred stock is viewed as more similar. When you're dealing with preferred stock, it's somewhere in between equity and debt. There's features of both. So certain preferred stock in the code is actually treated more like debt, and it's not actually stock. But what they're saying here is it has to be stock in the corporation, the plain vanilla type common stock. You can have preferred stock, but there's certain types of preferred stock that actually would not be considered solely in exchange for stock. So here, all avocado is getting is stock. Okay, so it is solely in exchange for stock. Okay, requirement 3 is that immediately after the exchange. So it's important that we say immediately after the exchange. Such person or persons transferring the property are in control, and I'm going to define control in a moment, are in control of the corporation. So the best way to do this is look at before the transaction and immediately after. It has to be immediately after. That's the key, is immediately after. Okay? I'm going to talk about what exactly is control in a moment. Okay? So avocado and banana together, they get together and they form this corporation. So they're doing this together, right? It's both persons. Here it's persons because we have to look at avocado and banana together. Okay? If they were doing this separately, you would look at avocado individually, and then later you look at banana. Okay? But since they're doing it together, you have to look at them together. So we do the before and after test. Before versus after. So before this transaction, what does avocado and banana have? They have this property, right? They separately have this property. Truck, power shovel for avocado, banana, cash, and land. All right? After, they no longer have that property, but they do have 50 shares of common stock. And there's 100 shares total. So they, afterwards, they own together 100 out of 100 shares of common stock, which is the only amount of shares. So they own 100% of the corporation. So the definition of control, which is defined in Code Section 368, there's two requirements. It has to be 80% or more of all stock, and it also has to be 80% or more of voting stock, So if it was some preferred stock here, then you would look at, okay, does it vote? Usually preferred stock doesn't have the same voting as common stock, so that could be an issue. So that's really what you have to look at. It has to be both. It has to be both 80% or more of all stock and 80% or more of all voting stock, of the voting stock that's outstanding. That's outstanding, okay? This is for outstanding, okay? Well, we do have that here because they have 100% of the only class of stock, so they do have 100% of all, and the common stock, since it's the only class, is the only voting stock, so we meet the third requirement as well. So that means that Avocado, of this $75,000 realized gain, Avocado recognizes $0 of gain or loss. That's the answer here with respect to step one. Okay, remember step one was what amount of gain or loss does the transferor shareholder, here we're looking at Avocado, what amount does Avocado recognize? Well, the answer is 0. The answer is 0. Now, there's a few things I want to talk about here just to give you some of the issues of what you could see. We talked about the definition of property. That's a big thing for the first requirement. Property is transferred to a corporation. The solely in exchange requirement. Okay, let's say you do get something other than stock. If you do get something other than stock, then you go to section 351B. You fail this, but you can go to 351B. And we actually have another checklist that deals with that, and you'll see that in another problem, okay, which deals with 351B. Requirement 3, immediately after exchange, what exactly does that mean? Does that it has to be like simultaneous like we have here, simultaneously at the same second? Or can it be, one person does one day and the next person transfers the next day? Well, there's a case on this, Intermountain Lumber, that deals with this issue. And what it says is that if you have some type of binding agreement that states that the parties together, go in with the plan that they, they plan this together, then the idea is that it will be viewed as immediately after the exchange, okay, to get that to qualify for all parties. Because if you didn't have that and we had Avocado come in at first and form the corporation, and Banana comes in 6 months later and it's not part of the same group and Banana gets 50% of the stock, well, guess what? Banana fails. Banana is less than 80%. So Banana would have to recognize gain or loss on the potential for there, which we're going to see when we go through the consequences for Banana later on. So that's important to understand. So if we fail requirements 1 or 3, we're done. If we meet requirements 1, if we fail either requirements 1 or 3, we're done. You can't get any non-recognition. All $75,000 is going to have to be recognized. But if we do meet number 1 and number 3, but we fail number 2, then again we have to go to section 351B, which you're going to learn more about in later problems when we have boot. Okay, so let's go into step 2 for Avocado. Okay, so now that we've determined step 1 for Avocado, and we've determined that there's a 0 recognized gain, we now go to step 2, where we determine the adjusted basis of the stock and property that Avocado has received from Coconut Corporation. So here, Avocado has only received 50 shares of Coconut Corporation common stock, so that's what we're determining. We determine the adjusted basis of the 50 shares of Coconut Corporation stock that Avocado has received. Now, if section 351 A or B, so we'll just say if section 351 applies, then we have to use the corresponding non-recognition rule, basis rule. Remember that every non-recognition rule has a corresponding basis rule, which is found in section 358. And section 358 basis rule is a formula that goes through various things and it takes into account and adds them up or subtracts them out to determine the basis. We always start with the sum of the adjusted basis of property given up by the transferor shareholder. So here, that is going to be the adjusted basis of the truck, which is $50,000, and the adjusted basis of the power shovel, which is $125,000. So we add those together, $50,000 plus $125,000, and that equals $175,000. So that's our starting point. We start with that. Again, if Section 351 applies, we have to apply this Section 358 basis rule, and that's our starting point. From that, we subtract away actual cash received. Did Avocado receive any cash from Coconut Corporation? No, right? No actual cash received, so that's going to be minus 0. Then we subtract away any constructive cash received. And remember that constructive cash received means liability relief, meaning that if any of the property that Avocado contributed to Coconut had liability on it, and then Coconut assumes or takes subject to that liability, that would be constructive cash received, which is liability relief. Is there any liability relief here to Avocado? And the answer is no. That would be subtracted out if you had that, but that's not here. We also subtract away the fair market value of any non-cash property received that is not considered, that qualifies for Section 351, which would be the stock or whatnot. Well, Avocado did not receive any property other than the stock, which qualifies for Section 351, no boot beyond this stock. So therefore, that's going to be, we're going to subtract 0 there as well. And the last thing we do is we add in any gain recognized as part of a Section 351 transaction. Now, Avocado did not recognize any gain here, so we're going to add 0, but you're going to see in future problems that it's possible to recognize gain, especially if Section 351B applies, where there is boot and there's a partial non-recognition rule apply. So we go through 175,000, there's nothing to subtract or add, so the basis of the 50 shares to Avocado is 175,000. So you would just divide to calculate the basis per share, but to calculate the basis of all the shares together is 175,000. All right, so now that we've calculated the adjusted basis of the 50 shares to Avocado, that was step 2. Step 3 is to calculate the transferor shareholder, here Avocado, the holding period of the stock. And the reason, again, holding period matters so much is because if Avocado were to sell the stock the next day, all 50 shares the next day, that characterization would be capital. That would be a sale of a capital asset because Avocado is not a dealer in securities. So Avocado would have a capital asset, but the question becomes, what is it long-term capital gain or short-term capital gain? And you might be thinking, well, she's only held it for a day if she sold it, a day after this transaction. And actually, the Internal Revenue Code, the tax law, under the holding period rules, actually allows tacking to occur in certain cases. So tacking, which means you get to add on, that's simply what tacking means. You get to add on a holding period, some other holding period, is allowed if the assets that are transferred are capital assets or Section 1231, qualify for Section 1231 asset. So we have to specifically look at the assets that Avocado transferred. Now, a fresh start takes place, which means no tacking, if it's not one of these categories, it's not a capital asset or a Section 1231 asset, or another one where a fresh start takes place is if it's cash. And the reason is because cash is actually a capital asset, but it never has any holding, there's no holding period for cash. Never has a holding period. So even though it does tack, you'll be tacking on 0. So practically speaking, the fresh start also applies to cash. just so you know. Because the tacking, I mean, theoretically, technically, it actually does tack, but it tacks 0. Practically, there is no tacking on cash. It's a fresh start. Fresh start means that it starts as of the day the shares are received. Okay? So we look at the property that Avocado transferred. We look at the property transferred by Avocado. And we have the truck and a power shovel. We have a truck and we have power shovel. Now we're dealing with the holding period of the common stock, which here is the 50 shares in the Coconut Corporation. But this is what's used to determine the holding period of that item. Okay? We look again if it's a capital asset or 1231 asset at the time it's transferred. So the first item is a truck that's held for business. So if it was used in business and held for more than a year, it's a Section 1231 asset, which is exactly what we have here. This is a Section 1231 asset because Avocado used it in business. It was and it was held for more than 1 year. Okay, it was used in business, subject to depreciation, or if it's real property, it has to be subject. I'm sorry, if it's personal property, it has to be subject to depreciation or amortization for intangibles. And it was held for more than 1 year. It was 3 years. It was 3 years. Okay, it was 3 years. So it's a Section 1231 asset. So that portion tax. The power shovel also, it was held for business, and it was also more than 1 year, so it's also a Section 1231 asset. So that means that since all the assets tack, it all tax. So we actually get to add on this period of time. Now you might be saying, okay, well, do we do 3 years for some and 13 months for others? It doesn't matter. It's still greater than 1 year, and since it's greater than 1 year for both of these, you just say simply it's long term. That the stock is now long-term, it's taxed long-term. So the answer here is that because they're both Section 1231 assets, there is tacking on the 50 shares of common stock. That's the answer. And it's automatically long-term as of the day it starts. Now, what would happen if they did have different time periods? Maybe something is a capital asset, but it's less than a year. And then, or if you had something that's maybe one qualifies for this, but one doesn't qualify. We're going to see that later on when we do banana. But I'll just tell you right now, you have to do a proration, a relative fair market value. So you look at the fair market values, and then you say, okay, well, a portion of each share, not 10 shares and 40 shares. No, we do a portion of each share is considered tacking, and a portion is not tacking. Or a portion tax for this amount of time, and a portion tax for this amount of time. So we'll see that later on. Okay, so we've gone through steps 1, 2, and 3 for avocado. Now we need to look at banana. And we're going to do the same 3 steps for banana. So step 1, we have to determine, again, the recognized gain or loss on this transaction for banana. So the recognized gain or loss for banana. So this one's going to be a lot faster. If there's any respective issues that banana has that avocado doesn't have, I'll bring your attention to that. But remember, whenever we're doing recognized gain or loss, we first start with the realized gain or loss under Section 1001. So that's what we start with, because if the realized gain or loss is 0, then why even calculate recognized gain or loss is going to be 0 as well. Recognized gain or loss, we start with the gateway provision. That's the realized gain or loss. That's the amount realized minus the adjusted basis. And that gives us the realized gain, or if it's negative, the loss. So the amount realized, remember, is any cash received, any non-cash property received, the fair market value of that, any liability relief, and you subtract away any selling expenses. So again, it's 4 items. Number 1, cash received, plus number 2, fair market value of non-cash property received, plus number 3, liability relief, minus selling expenses, number 4. The adjusted basis, you simply look at the adjusted basis of the property that's given up with respect to this transaction, and that gives you realized gain or loss. So here, banana, What is Banana getting? Banana is getting 50 shares of Coconut Corporation common stock. Remember that the value of Coconut Corporation is $500,000 immediately after the transaction, because if you add up all the fair market values. So the amount realized to Banana is getting 50 out of 100 shares, so that's 50%. So the amount realized is 500,000 times 50%, which equals $250,000. $250,000. So that's our amount realized. It's the fair market value of the non-cash property received. And then we don't have any of the other three items. We don't have any cash received, we don't have any liability relief, and we don't have any selling expenses. So boom, we got our amount realized. Minus the adjusted basis, which remember is the adjusted basis, the sum of the property that's given up. So Banana is paying cash and also giving up land. The basis of the cash is the face value, $100,000, and then the basis of the land is $20,000. So we take $100,000 plus $20,000. We subtract away $120,000 right there. And then that gives us the realized gain. $250 minus $120, the realized gain to Banana is $130,000. That is the realized gain. So now we have to calculate the recognized gain or loss. The question becomes, okay, we have a realized gain. It's been triggered under, again, our realization event, looking at our actual realization event. But the recognized gain or loss, we have to go through our 3 steps for Section 351A. We always start with Section 351A. You'll learn more that if 351A doesn't work, then maybe 351B, but we're going to start always with Section 351A. So the first question is, do we have property transferred to a corporation? And here we do, right? Because Banana is transferring cash and land, which we talked about property being very broad. So property is being transferred to the corporation. So we have that. The second requirement is that on the other end, the transferor shareholder solely receives stock. So solely in exchange for stock. Do we have that? Yes. Banana is receiving 50 shares of Coconut Corporation common stock, which remember, that's plain vanilla stock. That's plain vanilla stock. So that is met. And then finally, the third requirement is that immediately after the exchange, the person or persons have control. Which remember, control is greater than or equal to 80% of all stock, and you need both of these, and greater than or equal to 80% of all voting stock. And remember, we look at the person or persons together if they're part of the same agreement under the Intermountain Lumber decision. And here, they're simultaneous, so we don't have to worry. Avocado and Banana form together, so we don't have to worry. It is together for both of those. So we look at the persons, Avocado and Banana together. And remember, I always like to do the before versus after test. So before the transaction, Avocado and Banana had no stock. After the transaction, Avocado and Banana own 100 out of 100 shares of common stock. So therefore, they have 100% ownership, which is greater than 80%, and there's only one class of stock. So that means all three are met. So that means that Banana has 0 recognized gain or loss. 0 recognized gain or loss. So no gain or loss is recognized. No gain or loss is recognized by Banana in step 1. All right. So now that we've gone through step 1, we need to determine the adjusted basis of the stock received by Banana, which is step 2. So we're determining the adjusted basis of the 50 shares of Coconut stock. And that's to Banana. And remember that if Section 351 applies, 351A or 351B, which we did in step 1, then we have to apply the adjusted basis rule, AB, adjusted basis rule, under section 358, which is a formula. The starting point is we carry over the adjusted basis of the property transferred. The property transferred, which here, Banana transfers cash, which has a basis of $100,000, plus the adjusted basis of the land transferred, which is $20,000. And that's always our starting point. And usually when you have a non-recognition rule, that's almost always the starting point, is you carry over the basis in some way. From there, we subtract away any actual cash received, which Banana received none. So we subtract away 0, minus any liability relief. Did Banana have any liability relief? Did the land have any mortgages on it, or that Coconut took over? No. So no liability relief. Any non-cash property boot that that Banana receives? No. So that's also going to be minus 0. Finally, we add to that any gain recognized. Was there any gain recognized in step 1? That's where you get the gain recognized, is from step 1. No, there was not. So we add 0 to that. So we simply just carry over the $120,000, and that is the basis of the 50 shares to Banana. So if you're trying to determine the basis per share, it'd be $120,000 divided by 50, and that would give you the amount per share. Okay, so now that we've gone through steps 1 and step 2 for Banana, next thing we do step 3, which we determine the holding period of the 50 shares. We determine the holding period of the 50 shares of common stock in Coconut Corporation. And remember that when it comes to holding period, for the transferor shareholder, you get to tack any capital asset contributed or Section 1231 asset. Section 1231. But there's no tacking for non-capital or 1231 and cash. And cash. Cash does not get tacking. That's because there is no holding period with cash. So we look at the assets that are contributed. The first one is cash. Well, as we just said, cash does not tack. So this is going to be a fresh start, which means that the holding period starts as of the day that this exchange takes place. The second asset contributed is land. Now we have to look at the land. How was the land held? Well, it was an investment. If the land was an investment, it was a capital asset. This is capital, and therefore this is tacking. This is tacking. Now it's for 10 years, so it's automatically long term because it's over 1 year. So that portion is going to be long term, and then the rest is going to be fresh start. So the way this works when you have a mixed holding period is you use fair market value, relative fair market value to allocate. So, and you do this per share. So let's say we have, I'll do this over here. We have 1 share, we are Banana, and we have 1 share of Coconut Corporation. Now we have 50 shares, but we do each share. That means a portion of the share at the date will be fresh start, FS, and the other portion will be tacking long term. Okay? Automatically long term. Now this fresh start can get to long term, and everything all becomes long term once the property's been held for more than 1 year, a year and a day after this transaction. But this is saying, what if Banana was to sell the shares, the next day or a month down the road? Well, then you have to look at and you have to break it down. So the way we do this is we use fair market value of these 2 items. So if we add these 2 together, right, this equals the fair market value total is $250,000. $250,000. So that means that the fresh start portion is 100, the cash portion, over 250. 100,000 over 250, so I just kind of simplified that to 100 over 250. And the long-term portion, which came from the land, is 150 over 250. 150 over 250. So that means that each share, 40%, 10 over 25, or 100 over 250, which is 40%, and then 60% is long-term. So that is the answer. 40% fresh start and 60% tacking, which in parentheses long-term. Okay? Long-term. So now that we've broken down 40% fresh start and 60% tacking, let me just add some facts here later on. Let's say a month later after this transaction, Banana sells all 50 shares to Cherry 1 month later after the transaction for $270,000. And I want to show you how this is going to work, what this actually does. So we have a sale of stock. So we apply our gateway provision for property, right? 1001, which is amount realized minus adjusted basis. And that gives us the realized gain, or if it's negative, the loss. So the amount realized here is what Banana is getting. Banana gets $270,000, and we're determining the tax consequences here to Banana. That's what we're looking at. We're looking at Banana. Minus the adjusted basis. The basis of the property that we calculated in step 2. In step 2, we determine the basis of the 50 shares under section 358 is $120,000. Applying our section 351 and 358 rules. So that gives us a realized gain of $150,000. Now that realized gain is going to be recognized because there's no non-recognition rule when you get cash. There's no liquidity issue there, right? You can pay your taxes. You're getting cash. So usually when you sell something for cash, you don't have, there's no way you can, and you get it all at once. There's no way you can defer any gain through a non-recognition rule. So now the issue becomes, okay, Banana has a recognized gain of $150,000 on this transaction. What is the character? Remember, that's one of our 5 questions we always ask in tax is what is the character? Well, the character, 1 month after that, we have to apply this rule because we did a fresh start and 60% tacking. So 40% of this, it's all capital, right? All of this is capital. It's all recognized as a capital gain because if you're not a dealer in securities where you have inventory, your securities are considered inventory, the stock to you is considered a capital asset under the definition of a capital asset. So this is all a recognized capital gain. The question is, what portion is long-term, what portion is short-term? So we have a 40% fresh start and we have a 60% long-term tacking, which is automatically long-term as of the day this took place. Now that fresh start is only 1 month. Okay? Only 1 month. So since it's less than since it's a year or less, right? It's not a year and a day or more, then this is going to be short-term. This is all considered short-term. So 40% of 150,000 is $60,000, and this is short-term. And then this is automatically long-term because, again, it was long-term from the tacking as of the day it was transferred. This is going to be $90,000 that is long-term, and they're all capital gains. So this is $60,000 short-term capital gain, $90,000 long-term capital gain. So Banana would have to report $150,000 of capital gain on the tax return. $60,000 would be short-term capital gain subject to ordinary income rates, assuming that it's not net of a short-term capital loss or a long-term capital loss or the $3,000, not the $3,000. That's if you go against the losses. But if there's nothing to offset it, it's going to be treated as ordinary income. And then $90,000 long-term capital gain gets the preferential. So that just shows you how exactly this works. All right, that just shows you how exactly this works when it comes to the fresh start and the long term. Now, if Banana held, this was sold, 1 year, 1 month later for $270,000, then it would all be long-term because the fresh start would be 1 year, 1 month. The 60% tacking would automatically be long-term as of the day. So it's long-term plus 1 year, 1 month. So it would just be $150,000 long-term capital gain. So that is how it works. So now we've gone through steps 1, 2, and 3 with respect to both transferor shareholders, avocado and banana. So now we're looking at steps 4, 5, and 6, which look at the corporation, Coconut Corporation. And we're going to first start with step 4. And step 4 determines the recognized gain or loss by the transferee corporation, which here is Coconut Corporation. Now, Code Section 1032 deals with formation and contributions, and the party that it pertains to is the corporation transferee. It says that no gain or loss is recognized with respect to formation or contributions by the corporation. So this is very broad language, very broad. So that means that with respect to this transaction, Coconut Corporation has no gain or loss recognized. Very broad language. So in step 4, we saw that Coconut Corporation has no gain or loss recognized, and that's very broad language under Code Section 1032. So now we have to look at step 5, and in step 5, we determine the adjusted basis of all property received by Coconut Corporation, by the transferee corporation. All property received by the transferee corporation. So here, it's what avocado transferred and banana transferred. It's all those things. So it's the truck, power shovel, cash, and land. Okay, so we're going to go through all 4 of those things and determine the basis. Now remember that whenever there is a non-recognition rule, which we saw in step 4, is Code Section 1032, which says no gain or loss recognized the transferee corporation on formation or contribution. There's a corresponding basis rule that applies to that, and that's under Code Section 362. Now, just like we have a formula for the transferor shareholder under Section 358, Section 362 is the adjusted basis rule that also is a formula, and it's a lot easier formula. So the formula for Section 362 is the adjusted basis. It starts with the adjusted basis of the property transferred. So again, that starting point for non-recognition basis rule, adjusted basis of property transfer. So we carry it over. So here, for the truck, the power shovel, the cash, and the land, we carry that over. So adjusted basis of property transferred. And we add to that any gain recognized. Any gain recognized by the transferor. By the transferor. And really, it's with respect to that property that's being transferred, and creating gain. It has to be with respect to that property. You're not going to see on this problem, but you're going to see later on some more sophisticated issues where, only certain property do you add on a gain or take into account the gain or whatnot. And that gives you the corporation's adjusted basis in that asset going forward. That gives you the corporation's adjusted basis in that property. So again, it's a carryover basis plus the gain recognized, and then we add those two together, and we get the corporation's adjusted basis. Now, that is the general rule under Code Section 362. There is a special rule that applies when the adjusted basis of the property is greater than fair market value. And if the adjusted basis is greater than fair market value, then you use fair market value. Then fair market value is used as the basis. Fair market value is used as the basis. That's a special rule. Now, when we take into account the adjusted basis and the fair market value, we do the total for taxpayer, for the shareholder. The total for the shareholder. And I'll show you what I mean in a moment when we go through avocado. We're going to go through avocado, and you're going to see this issue. It's going to come up. So that's a total for the shareholder. You total up all assets, and you see, does the total adjusted basis, is that greater than the fair market value? And then the asset that where the adjusted basis is greater than fair market value, that's where you apply fair market value. That's how it works. That's how the special rule works. Okay, so let's apply this rule, these rules, the general rule and the special rule, to the 4 pieces of property. Let's just go in order by avocado and banana. So we have a truck, we have a power shovel, we have cash, and we have land. And again, remember, in step 5, we're determining the adjusted basis of the property that the corporation is receiving. And we start with the adjusted basis that the transferor had in the property, which is given. And then we add to that any gain, if any, which there's no gain to any of these, right? There's no gain. So for either party in step 1, 2, and 3 for either had gain. So we can just go ahead and put 0 for all of these. There's no gain. And then we add those together and we get the adjusted basis. Now again, there's an exception where the adjusted basis is greater than the fair market value, so we have to test that as well. So first, let's go with the truck. So we look at the truck's adjusted basis and we see it as a $50,000 adjusted basis, fair market value $150. Again, the special rule only applies if the adjusted basis is greater than the fair market value, and then you gotta look in total as well. So you have to do this individually by each asset, and then when you do the test, you do it in total. So I'll show you what I mean in a moment. So the special rule does not apply because when you look at the truck, the adjusted basis is less than the fair market value. So the adjusted basis of the truck is $50,000 plus 0 gain. So the corporation takes a basis in the truck. So this is the corp's adjusted basis, $50,000. The power shovel. So the power shovel, the adjusted basis is greater than the fair market value. So you would think the special rule would apply. However, to test the special rule, we have to add up both of these. So we have to do the total adjusted basis. That has to be greater than the total fair market value. So here the total adjusted basis is 175. The total fair market value is 250,000. So because this fails, the special rule does not apply. The special rule does not apply. So we use the general rule and we go ahead and we use 125,000. The adjusted basis. The general rule does apply. So the corporation's adjusted basis in the power shovel is 125,000. We do cash. Well, cash is always with the face value that's given. 100,000 adjusted basis, it's always going to be equal to the fair market value. So the cash adjusted basis is going to be the face value, which is 100,000. The land. The adjusted basis is less than the fair market value, so we're fine with the general rule. So we go ahead and we take the 20,000 plus no gain recognized is a $20,000 basis to the corporation. Pretty easy, right? That's how that works. And again, the gain comes from step 1, step number 1, and that's why if you do these steps in order, it makes things a lot easier. Versus if you had to do this step, if you just went right to this step, you would have to go back to step 1 and then come back to this. So doing this in order helps out tremendously. So I want to go back to this power shovel. What if we change around the facts? And instead of having an adjusted basis in the truck equal to 50,000, we change that adjusted basis in the truck to 140,000. So the adjusted basis is now 140,000 for the truck, which is still under the fair market value. So I want to show you how that's going to affect the power shovel. Because the truck, that's still going to stay the same. The cash, that's still going to stay the same. And the land, that's still going to stay the same. But the power shovel now is going to change, and I'll show you why. So as I mentioned earlier, if the adjusted basis is greater than the fair market value, then you have to apply the special rule. But you also have to look in aggregate if you have multiple assets. So really, the thing to take away here is if a taxpayer is only transferring one asset and the adjusted basis is greater than the fair market value, then you're going to use the fair market value as the adjusted basis. You don't even look, that's what you use. But if you have multiple assets, you have to apply an aggregate approach. So here, we're looking at the power shovel. Again, the truck, the cash, the land, those, they're not an issue because their adjusted basis are all less than the fair market value. but the adjusted basis, the power shovel, is greater. So we have to apply, when you have more than one asset, you have to apply the aggregate approach, which means you look at all assets, the aggregate approach. So we take the total adjusted basis, which here is 140 plus 125, that's 265,000, and you compare that to the total fair market value, which is 250,000, and look what we have here. The total adjusted basis is greater than the total fair market value, so this is going to be, the special rule does apply. Now when you have the aggregate, you actually take the difference. You take the difference of these items. So here the difference is 15,000, that change. The adjusted basis, when this special rule applies, you go to the asset that creates it. So here, there's only one asset that's greater. Now, if there's more than one asset that the adjusted basis is greater than fair market value, you're going to have some allocation issues, but you're likely not going to see that on, a CPA exam or, your actual exam. You can see it in practice, and you have to apply proration of that, method. But here, there's only one asset that creates it. So what we do is we take the adjusted basis as a starting point. We take the adjusted basis as a starting point. We bring that down. We subtract from that this change, this difference. The amount over the fair market value is over to get to the adjusted basis. So we subtract the $15,000 difference between the two, and we get the basis that we actually use. So again, if you only have one asset and the adjusted basis is greater than fair market value, you use fair market value. But if you have more than one asset, and then you have to apply the aggregate approach, and what you do is you take the difference and subtract that away. So the power shovel here, in this example, where we change, the fair market values all stay the same, banana stays the same, the only thing we changed was the truck went to 140,000 adjusted basis. You notice that instead of having the 125,000 adjusted basis like we had in our normal facts, now it goes down to 110 because the truck's adjusted basis was raised to 140, and we had the aggregate approach that applied. All right, so now we're back to normal, and we just dealt with steps 4 and 5 for Coconut Corporation, and we're dealing with step 6. So we're back to our normal, what we had from the beginning, our facts. I switched it back. The adjusted basis is now 50,000 for the truck. So step 6, we determine the holding period of all property that the transferee corporation receives. And that here is Coconut Corporation. So we're talking about the truck, the power shovel, the cash, and the land. Now, this one's pretty easy. Under the holding period rules, all assets tack. All assets tack. So that means that all the truck, power shovel, cash, and land, all assets tack. So when they're sold, they get the period of time that was held by the transferor shareholder. So the truck is going to tack 3 years. The power shovel is going to tack 13 months. The land is going to tack 10 years. Remember, cash doesn't have doesn't have any holding period, and it wouldn't going forward in the future anyways. So it doesn't make a difference. So all assets tack. So if the corporation later, sells property or whatnot, disposes or does whatnot, you can use that in determining the gain or loss. Long-term capital gain for the corporation, which remember, corporations don't get preferential rates, but it still makes a difference with respect to the netting of capital gains, capital losses. It makes a difference of 1231 and whatnot. So that's very important. So I know this has been very exhaustive. We went through all 6 steps. I highly recommend watching this many, many times, because if you go through this is really the basics. Make sure to watch the extra problems that I have, because I'm going to be going over some additional issues in those problems, like boot, liability relief, those kind of things, which are all extremely important when it comes to corporate tax.